So we have now greater confidence that inflation is moderating, but we are acutely aware that there are significant risks. I have made a reference to the data released just about a week ago by the FAO and the World Bank with regard to the commodity prices, including food also. We have to be very careful. So therefore, we have changed the stance at the moment because we see that growth and inflation, they are well poised. The balance is well poised. So the MPC considered it appropriate. The timing is appropriate to shift the stance to neutral.
So it's a pivot.
No, that is for you to assess whether it's a pivot. And neutral stance, as I said in the statement, it gives us optionality and flexibility to take decisions. As I have already articulated, the first quarter numbers should not be, which came at 6.7%. It was primarily due to lower expenditure by both central and state governments. Maybe because of it coincided with the election season. In fact, but we now get a sense that both state and central government expenditures will meet their budget figures, will meet their budget estimates. An important aspect also which has been perhaps missed out, but which was highlighted in the State of Economy Bulletin article of which was released in September, in the last month's bulletin article. Now, if you sort of, the first quarter, the subsidy payout was very high by the state governments in particular and also to some extent by the central government. So, GDP is basically GVA plus subsidies, plus indirect taxes minus subsidies. That is plus indirect taxes minus subsidies. Subsidies were very high. In fact, if you take out the effect of the subsidies, the GDP growth would have been quite above 7%. I do have the number, but I don't want that to be a headline. The actual GDP growth would have been upwards of 7%.
Is the RBI's decision to keep interest rates unchanged a prudent and well-considered move? Headline inflation has moderated, but is it likely to rise again due to geopolitical tensions and increasing commodity prices? Domestic growth remains strong, with urban demand holding steady and rural demand showing signs of improvement. So, was it wise of the members of the Monetary Policy Committee to observe that the situation for a few more months will need to be watched out for before they consider a strategic cut in the interest rate? What does the RBI shifting its monetary policy stance to neutral mean for liquidity conditions and for growth? And has the stage been set for a potential rate cut in the future? To discuss these and more questions arising out of the latest move of the Monetary Policy Committee of the Reserve Bank of India, I am joined by noted economist Madan Sabnavis, Chief Economist at the Bank of Baroda. We are also joined by Shubha Rao, founder of Quant Eco Research, and Rumki Majumdar, economist at Deloitte India. Madan, coming to you, RBI has maintained a status quo on the repo rate for the 10th consecutive time. No rate action. Why do you think the MPC did what it did?
See, so that if you look at the projections made by the RBI on inflation, we're looking at a number of 4.8% for Q3. And then, of course, it's coming down to 4.2 or so in Q4. So if my inflation number is going to be 4.8% in the coming months, which is based on the fact that we have a normal monsoon, but yet on account of maybe certain base effects and the fact that core inflation is increasing, there's reason for us to believe that inflation is going to increase from 4.1% in Q2 to 4.8%. I think logically one cannot take any decision on the interest rate. So I think the RBI has been harping on the fact that they're looking at durable low inflation. They have also pointed to certain risk factors which are there, weather conditions, geopolitical tensions which are there, as well as the fact that global commodity prices are increasing. So I think this kind of a surrounding, it made sense for the RBI to hold on to the repo rate, go in for the stance change, because when you change the stance, you send a signal to the market that a rate cut would be in the offing, though the timing, of course, hasn't been specified, and I think it will be data-driven.
Shubhda, the risk factors that have been cited, you think they are significant because we are seeing interesting dynamic play out, for example, on crude oil. The West Asia crisis doesn't seem to be worsening, and crude oil also isn't reacting so wildly that it was. So, are these significant risks for that justify the MPC's move?
I think I quite initially first concur with Madan that, by moving to a neutral stance, what RBI has done is introduced a softening bias going forward. Having said, to answer specifically to your question, what are the risk factors and what are the spillover issues that may culminate into any inflation trajectory, direction, or whatever? I would think that while crude oil prices may still remain range bound, of course, unless it gets into a full-blown war, the escalation has been pretty severe over the last few weeks. But given the supply conditions and the softening demand conditions globally, that is primarily the reason why crude oil prices have not seen a runaway momentum. In fact, they have been yo-yoing, few days up and last 2 days have been softening. Having said, I think RBI's larger concern to my mind would be the climate impact on the domestic food price inflation. While there is a comfort going forward into the last quarter of this fiscal year, the near-term concerns still remain. There are tail risks related to food inflation. RBI has already given a heads up on September and October risks to headline CPI remaining elevated, in fact rising by a fair margin. And at this juncture, therefore, it's prudent to remain cautious when there are tail risks to inflation. So I would say while global risks may not directly and immediately culminate into inflation moving down if the crude oil prices remain range, I think a larger attention would be paid on the domestic factors and what he cited about the FAO also projecting food prices and metal prices moving up. I think that these are some of the factors that probably went into remaining cautious as far as RBI's pronouncement of staying put today was concerned.
Rumki, staying put, but a change in the stance from withdrawal of accommodation to neutral. Take that point forward. Does this point us towards something happening in perhaps in December?
Hi, Siddharth, thanks. Yes, a possibility is there that the RBI may decide to go for a rate cut in December. But I think the next couple of months will be very critical because what we have noticed that while inflation, overall CPI inflation came down below 4%, the rural inflation has been still very high. It's still around 4.2%. And given that food inflation continues to remain high and it impacts rural demand, which is kind of seeing some green shoots. So I think what RBI will do is take a keenly observe how these prices, food prices, commodity prices, as has been discussed earlier, are going to move forward. Plus, given the fact that the US Fed has also cut policy rates, and they are already higher on inflation than what it should be as per the Fed target rate. So that is again another consideration because if inflation up there also jumps up, then it could actually have an impact on our imports and import prices. So I think in India will try to monitor all that and then decide forward.
Madan, you would have heard the RBI's bite, the governor's bite on growth, and I wonder if the second bite can be once again played. I'm going to try and request my producers to play that out again because then I want to go to Madan and focus on the growth bit because there was a very interesting candid response from the governor. Let's take a quick listen into what the governor had to say, the second part of his bite on growth and subsidies.
as I have already articulated, the first quarter numbers should not be, which came at 6.7%. It was primarily due to lower expenditure by both central and state governments. Maybe because of it coincided with the election season. In fact, but we now get a sense that both state and central government expenditures will meet their budget figures, will meet their budget estimates. An important aspect also which has been perhaps missed out, but which was highlighted in the State of Economy Bulletin article of which was released in September, in the last month's bulletin article. Now, if you the first quarter, the subsidy payout was very high by the state governments in particular, and also to some extent by the central government. So, GDP is basically GVA plus subsidies, plus indirect taxes minus subsidies. That is plus indirect taxes minus subsidies. Subsidies were very high. In fact, if you take out the effect of the subsidies, the GDP growth would have been quite above 7%. I do have the number, but I don't want that to be a headline. The actual GDP growth would have been upwards of 7%.
Madan, decipher this for us. What is the governor trying to tell all of us?
See, actually, I think what the governor was trying to say is that GDP growth for the year remains unchanged at 7.2%. Now, one might have gotten a sense that in the first quarter, the GDP growth at 6.7% was something on the lower side. And how is it that we're going to get 7.2% for the full year? So I think here the governor has actually said that your consumption has revived. It's also signs that investment has revived. So there are two engines which are doing well. Now, what happened in the first quarter was that we saw that the gross value added actually grew by 6.8%. And I think what he described was the difference between GDP and GVA, where the difference comes from the net indirect taxes, of which one of the large components was subsidies. And since a large amount of subsidies were paid in the first quarter, probably because we had elections coming on, there was some kind of front loading out there. So therefore, that was the reason why the growth in GDP was only 6.7%. Now, this kind of thing is going to get reversed. And as tax collections continue to be buoyant, and we also see that there's less pressure to push forward with subsidies, there would be a tendency for GDP growth to get realigned to the normal path. And that's how we'll be getting into this range of 7.2% and the number moving sequentially in the next 3 quarters. So the essential point is that definitely there is no reason for us to believe that we are off this particular trajectory of 7.2%. And I think this becomes very important, Siddharth, because when we are saying that GDP growth is on the right path, it also means that as a central bank, you don't have to worry about saying that, look, if I don't cut interest rates now, will it come in the way of growth? No, growth is going on the way in which it was projected in the beginning. And therefore, the MPC could continue to concentrate more on the inflation part.
Shubhda, growth continues at 7.2%, and while one can't disagree with what the governor of the RBI is saying, there are important state elections that will continue. So I don't see the subsidy tab being turned off, but let's leave that aside. Growth will continue, but a 6.5% repo rate, when inflation is 4% plus a few points here or there, isn't that quite significant to continue to maintain in any case?
I think, yes, real rates would be at some point in time taken on board as far as, support to growth is concerned. As of now, I think a 7 to 7.2 does not trigger any significant concern for RBI that interest rates have begun to hurt. As governor adequately and more than once alluded to, fair revival in rural demand, urban demand remaining steady, and also importantly, while the first quarter saw constrained government expenditure because of the model code of conduct due to elections, I think Q2, Q3, Q4 of this fiscal would be where the government does a catch up on its expenditure program. So investment led by government will also add to the support. Having said, I think we are looking at an average inflation for the year at 4.5. Now, do you look at 2% real rates? In recent study by RBI, they've said that it's 1.8 or 1.9, which subsequently should be trending lower. It indicates that as we go forward in terms of seeing a lower trajectory of CPI inflation, the real rates would also, then need to get aligned. And from that perspective, we believe that RBI would be poised to cut rates sometime between December and February. Admittedly, even the governor said that rates are high, which basically implies that, and as Madan was also alluding to, while the growth remains intact, they do have flexibility of focusing significantly much more on managing inflation and bringing inflation closer and in alignment with its central target.
Shubhda, I'm sure both you, Madan, and Rumki as well continue to take note of the fact that retail pump prices of petrol and diesel have remained unchanged now for 2 years, and counting at that brunt is being borne on the fiscal side and not on the monetary side. And what that means in real terms for the actual inflation if there were to have been a pass-through. But Rumke, I'm coming to you to take up the point that Shubhda made between December and the quarter that comes after it, the first quarter of the next calendar year. Do you think the status quo currently paves the way for that kind of rate cut? And if so, what quantum can the markets try and factor in at this stage?
Right, and as the panelists mentioned, that the credit growth right now is very healthy. And in fact, the RBI governor did mention that the risk taking is still quite high, and they probably keeping an eye on how how the NBFCs and MFIs are taking risks in lending. So a very cautious stance is justified. And as I said, the earliest we can expect is December, which also we expect the RBI may go for it or may not, depending on how this inflation kind of pans out, how the risk taking is factored in among the lenders, and also the fact that commodity prices have been very fluctuating. So far, it has not reflected on the because of the geopolitical uncertainties that we have seen, which kind of tells that the investors are kind of factoring in the uncertainties, and then they're going to continue for longer. So most likely a steady prices will help that way. But the governor is quite keen on looking at inflation, balancing the risks, and as well as how the growth it's actually whether it is hurting the growth or not. And so far we do not have enough evidence to say that. So in all, we expect most likely if the governor doesn't go for a rate cut in December, it might move it to February at the earliest.
Madan, look at some of the recent data, including what is happening as far as auto inventories are concerned. I wonder what kind of importance should we give to that, given that this point about improvement in rural demand is being made? Because if you look at the two-wheeler segment, for example, or the overall auto category, it's very different from what we had thought of maybe 6 months or a year ago.
See, we're talking specifically of auto. I think we should remember that the festival season has just about begun, and there'll be lots of purchases, if at all they're going to take place. It's going to take place in the months of October and November. So therefore, I think to look at this particular number which we got for September may probably not be appropriate. Besides, whenever you're looking at any of the economic data, I would always prefer to look at cumulative picture, because on monthly basis, depending upon how the reporting is done, there could be a tendency for things to keep going up in 1 month, coming down in another month. So I think we look at the overall cumulative picture, I think it's still fairly positive. So even if you look at the PMI numbers, we've been above 50. So I wouldn't read too much into the fact that we came below last month, because we should remember that these are all month-on-month estimates, or a month-on-month surveys which are being carried out. But I think the critical part will be what happens in October and November in terms of spending, because as I mentioned in the beginning, the two engines which need to fire are consumption and investment, because interest rates will matter only in case we reach a situation where industry wants to expand their capacity, but they're not in a position to do it, or maybe it's not economical because of high interest rates. Right now, I think there is adequate capacity in the consumer goods segment. It's what we see the infrastructure goods segment, where there is expansion taking place at a fairly good pace. So depending upon how the demand behaves in the next 2 months, maybe I would say right up to December, I think that's when we'll get a very fair picture about whether the consumption story has actually turned over and whether things are looking positive.
Viewers, there's also another interesting sidelight to today's NPC deliberations, and this is a dissent by one member. And remember, on the 1st of October, 3 new members, Shogoto Bhattacharya, Ram Singh and Nagesh Kumar, were appointed as the new external members of the Monetary Policy Committee, and they replaced Ashima Goyal, Jayant Verma and Shashank Bhide. Madan, I'll come back to you on that point. One of the new members, external members, Shogoto Bhattacharya, has been a frequent guest on this show and various others on Business Today television, just like all 3 of you. What does the new external member composition tell you, and this dissent, what can we speculate about it?
Yeah, it's a bit difficult for us to draw any conclusions right now, because we need to see how these new members, I mean, we'll get to know of it only when the minutes are released, as to how they have commented on the aspects of growth and inflation. So if you actually look at the previous panel which was there, we had been seeing that the two members who finally did tend to move in a different direction were the ones who were constantly looking at inflation and growth in a different way. I mean, they were focusing a lot on saying that high interest rates impedes growth, but actually that was not really taking place. So it depends upon the subjective view of how the members look at this inflation growth trade-off. And we can't really ascertain this in this particular from one particular policy. In fact, I would be a bit surprised that one of these members actually took a stance that we need to cut the repo rate, because I think it's a bit too early for one to jump to this conclusion. That's anyway my personal view, but obviously there must have been some convincing reasons which the member did put forward, which we'll get to know, I think, once the minutes are released.
Shubhda, what's your view on this point?
I would completely concur, because it's premature to comment, especially when they haven't yet been speaking enough on this particular aspect of monetary policy objectives and so on. So minutes will give us a peek into what their thought process is around growth and inflation dynamics. Of the 3, of course, one can say that one is more familiar with Shogoto, and one could therefore become more predictable about what his stance could have been. But as far as other 2 members are concerned, I think early days yet, we yet need to understand what their pronouncement would be on the macroeconomic balance or imbalance, if there is any. And minutes 14 days later would let us know what their direction of thinking is. Having said, I think, yes, I quite agree with you, Siddharth, that very first policy meeting and dissent vote, I think that was not anticipated. That also took me by surprise, that the very first meeting there was one dissent vote by from one of the new members of the committee. But I guess these are the times at the point of inflection you will have some kind of difference of opinion, and
we all like dissent, Shubhda. We all like dissent. We are a country full of dissent. But on a more serious note, I want to point out to our viewers. So while there was dissent on the rate part of it, on the change in stance, there was complete unanimity.
Yes,
Rumki, take that point forward. So on one aspect, crucial aspect of rate, there was a dissent by one person, but change in policy stance, everyone agreed. So kind of halfway house for whoever that dissenter was.
Yeah, well, we can see it that way as well. At least there is an effort that is being made to say that we also prioritize growth in conjunction with the inflation, because there have been a lot of debate about whether growth is slowing, and given the geopolitical situation that we are seeing, which could have an impact on investments and exports, could RBI do more? So I think the change in stance is an indication that the RBI is flexible, but as he rightly pointed out, that it is too early to open the gates, and I think it is right in his judgment to be very cautious, because once the foot is off the pedal and if the inflation goes out of hand, then things could actually impact growth as well. So I guess the divide could be there, debate would be there, but RBI's decision is very prudent.
Absolutely, and the wise members, the mandarins of the Monetary Policy Committee, all with dozens of years of experience of different kinds, and that manifesting in this decision, the 10th one on a trot where interest rates have been left unchanged. But like our economists panel has just told us, there are very, very significant points that have also been underscored and underlined in today's announcement. We'll also try and get you later some of the key views of Saugata Bhattacharya on interest rate cuts, and we'll wait for the minutes of this meeting to come out to finally figure out who was the member who called for a rate cut. For now, Madan Sabnavis, Shubha and Rumki, thank you very much for your time with us today. Viewers, with that, it's a wrap on this episode of Easynomics. We'll be back with more. Until then, goodbye. Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching our special coverage on the Silver Jubilee